Hello and welcome back to another demonstration video. So we had a request to do another demo video for a chapter 1 problem. So in class we said we agreed that we'd go over question 31. So we're going to go through question 31, which is on page 35 in my ebook here. So they tell us that on January 1st, 2023, Fisher Corporation purchased 40% or 80,000 shares of common stock of Bowdoin Incorporated for $982,000 in cash and began to use the equity method. So right off the bat, equity method, you should be thinking, how is net income of an investee treated by the investor, and how are dividends treated, specifically dividends of the investee, and how does the investor record those? Okay. So they go through and they give us a bunch of information. They tell us about the price that they paid. The price paid represented a $60,000 payment in excess of the book value of Fisher's share of Bowdoin underlying net assets. Fisher was willing to make the extra payment because of a recently developed patent held by Bowdoin with a 15-year remaining life. All other assets were considerably appropriate valued on the books on Bowdoin's books. So what we're going to do is they want us to prepare journal entries for Fisher for years 2023 and 2024. Okay, so this is actually a really good review of the equity method. Okay, so first thing I'm going to do is kind of create a journal here in Excel. So bear with me. Okay. Apologize, probably should have done this beforehand. Okay, so I got my debit column, got my credit column, center those two, got the account, and then we have the date column. Okay, so they tell us on 1/1/23 or 2023 that Bowdoin's the investee, right? We are Fisher, right? So bear with me here. Let me put that up there so we don't get confused. These are Fisher's books, okay? So on January 1, in 2021, Fisher invests in Bowdoin, right? They buy 80,000 shares of stock, which represents 40%, and they pay $982,000 for that, okay? So the journal entry for that's very simple. We're going to hit the investment account. Specifically, in this case, we're going to note Bowdoin in it. And we're going to debit that account for $982,000. And we're going to credit cash for the same amount, $982,000. Don't forget we need to put a description here. So, well, what happened? Well, we record the cost of 80,000 shares in Bowdoin Company. Okay. Now, what happens next? Well, they tell us that Bowdoin declares and pays a $100,000 cash dividend to its stockholders each year on September 15th. And then they go on to tell us that Bowdoin reported net income of $400,000 in 2023 and $380,000 in 2024. each income figure was earned evenly through its representative or through its respective years. Okay. They tell us on July 1st of 2024, Fisher sells 10% or 20,000 shares of Bowdoin's outstanding shares for $330,000 in cash. Okay, so read a little bit too much there, but that's okay. The next thing we need to record, based on what we just talked about, was the dividends, right? On 9/15 of 23, on 9/15 of 23, Bowdoin paid a dividend, right? They declared and paid an annual dividend. So remember, the normal journal entry for this is going to be a debit to cash and then a credit to investment, the investment account, Bowdoin. Now we need to figure out the dollar amount. Well, they tell us that they pay annual dividends of $100,000. But remember, we own 40% of that. So because we have this this symbiotic and this close relationship with Bowdoin, we need to show that, hey, when they pay us a dividend, or when they pay out a dividend, we as Fisher need to decrease the value of the investment. Okay, so we own 40% of it. So we're going to take $100,000 and multiply it by 0.4. That gives us $40,000. So that means that Fisher. Oh, no, that was right. Sorry. Like I was saying, because of that close relationship, what we need to do, or what we need to show, is that, hey, yes, we got cash, but because we have significant control over this company, they declared a dividend, we need to decrease the carrying value of this investment because they paid a dividend. Okay? The next thing that happens, well, it's the end of the year, right? And what happens at the end of the year? Well, they tell us, bear with me, 12, 31, 20, 23. It's the end of the year. Bowdoin reports net income. So, since we're Fisher, we must accrue the 2003 income based on our ownership in Bowdoin, which is 40%. So, remember, since we're recording net income, we're recording accrued income because we have significant control over this other company, or this investee. We're going to debit investment in Bowdoin by $160,000. Now, how did I get that? Well, think about it. We know that the net income is $400,000. There we go. $400,000. We own 40, or we're entitled to 40% of that. That's how I got my $160,000. Okay? So, we have income here. We debited investment in Bowdoin. We're going to credit equity in investee income for $160,000. Okay? And again, what happened here? Well, we need to accrue 2023 income based on 40% ownership of Bowdoin. Okay? Now, something else that in here that we got to take care of. Okay? They tell us that the price paid represented a $60,000 payment in excess of the book value of Fisher shares, Fisher's share of the Bowden underlying net assets. Fisher was willing to make the extra payment. Why? Because recently developed patent held by Bowden with a 15-year remaining life. So right off the bat, we need to show that there's going to be some amortization here, right? Why? Well, what's happening? Well, we have a patent. We need to amortize the cost of that patent over 15 years, okay? So again, we need to show that, hey, there's an adjustment here that we need to make. How do we do that? Well, we're going to do a journal entry. Maybe. There we go. We're going to do a journal entry on 12/31/23, okay? We're taking, and think about it this way, that amortization cost, that $60,000 excess patent value, right? We need to amortize that, amortize that over 15 years. So what's happening is we're saying that, hey, that you know what? Our investment in this Bowden company is going down. And in addition, that income that we get from them is also going down. So anytime we need to amortize, a patent or some intangible asset, we're going to do it systematically. So what we need to do is go ahead and hit debit equity in investment or investee income is going to be debited for $4,000. How did I get $4,000? 60,000 divided by 15 years gives me my $4,000. Okay, so we're showing that, hey, the net income that we received is going down because of our amortization, right? Which is what we're booking here. And then we need to decrease the investment account in Bowden by the same $4,000. Okay? Oh, 4,000. Now, what happens next? Well, they tell us, and let's think about this. They tell us that, hey, we have some net income in 2024, right? But is there anything on the timeline, right? And as I read over the problem, I'm thinking, okay, in my head, let me think of a timeline, right? What happened first, second, third, fourth, fifth, and so forth, okay? We already took care of 12/31/2023. In the problem, they tell us that on July 1st of 2024, we sold some stock, okay? So right off the bat, I have, and think back to the problem that we worked on in class, remember, or your homework problem, actually, where half the year, during the year, we had two different amounts. Same thing applies here. Our percentage in this company is going to go down because we're selling some stock, okay? So because we're selling stock, what we need to do is we need to figure out what's our cost, how much should we decrease the investment in, and how do we basically calculate those costs per share over the life that we've had the stock. How do we do that, right? Well, I'm going to come over to the side here, and we're going to work through that calculation. Hopefully you remember the steps from class. First thing we're going to do, I'm going to come right here, and we're going to say, okay, in 1/1 of 23, we acquired the stock. Okay, we acquired it for $982,000. Okay. On 9/15 of 23, they paid a dividend, right? That decreased our investment in Bowden. Okay. Let me go through this and then I'll tell you what I'm thinking. Okay. What happens next? Well, we have the oh, that's why. So we have the dividend on September 15th that was declared, $40,000. Then we needed to recognize the basic equity accrual, right? On 12/31/2023. And that amount was the 160,000. Okay. As we're going through this, right? Once you get the journal entries down, technically what we're really doing is the T account, right? We're trying to calculate the balance of this investment. We're doing it a little differently, but if you feel more comfortable, do a T account. Show you what I mean here real quick. Show you what I mean. So investment in Bowden. Right. Well, first thing we do is buy $92,000 worth of it. Okay, or $982,000. Well, it's an asset. I'm increasing the asset. It's a debit. Great. Investment in Bowden. Oh, what happened here? Oh, they paid their dividend. Right, that $40,000. Post it to the T account. Okay. We're doing the same exact thing. The concept is the same. I know it looks different, but the concept is exactly the same. Okay. So the next thing we have on 12/31/2023, we have the amortization, and that was the $4,000. That decreased the amount that we have in that investment. Okay. So what we're going to go ahead and do, bear with me here, sorry. We're going to go ahead and add this up. And we're going to see what is our cost in Bowden, right? What's the cost in it? So what we need to do then is say, okay, we have $1,098,000 in Bowden, okay? So what we need to do, bear with me here for 1 second. Sorry, I'm just going back and reading the problem. Net income report. Okay, good. Yep. So what we need to do is figure out, okay, well, what is our cost, right? So we get down to where we're at here and we say, okay, as of 12/31/2023, we have $1,098,000 in cost, right? But there's something in the problem that tells us that we need to do something, okay? They tell us that, or they go through and they say, the second paragraph of the problem says that Bowden declares and pays a $100,000 cash dividend to its stockholders each year on September 15th. Okay, cool. Bowden reported net income of $400,000 in 2023 and $380,000 in 2024. Each income figure was earned evenly through its respective years, okay? So what we need to do is we need to say, okay, we're not done yet. The reason why we're not done is because we're selling stock in the middle of the year, but because that net income was earned evenly throughout the year, we need to record a percentage of the income and a percentage of the dividend, okay? So the first thing we're going to do is we're going to come back to our journal entries, and we're going to say, okay, on 7/1/2024, we're going to record the accrual of a half a year of income at 40%, okay? Excuse me. The only reason why we're doing this now and not doing it at the end of the year is because the problem told us it was earned evenly throughout the year, okay? So what we're going to do is, remember, let's not worry about the calculation yet. the journal entry, which is very important to know conceptually, not being able to do it, but also being able to explain it, that, hey, whenever an investee reports net income, that investor needs to report their percentage in ownership and equity, and they need to increase their asset, which is that investment in Bowdoin, right? So, because we're talking about allocating income, we're going to hit investment, Bowdoin, and then we're going to credit equity in investee income. Okay? What are we doing here? Well, we're accruing 1/2 a year income of 40% ownership. Okay, perfect. So in 2024, what's their income? Well, they paid $400,000 in net income, or they earned $400,000 in net income, right? We own 40% of that, so we're entitled to 40% of that, but we're only taking 1/2 of the year. So we're going to multiply that by 1/2, and we're off. Why are we off? Bear with me here for 1 second. Oh, I know why. Because my number's wrong. 380,000 was made in 2024. So that was my fault. I apologize. Bear with me here. 380,000 times 40%, or 0.4, times 1/2 gets us 76,000. Okay? So we're going to increase our investment in Bowdoin. We're also going to increase the equity in investee income. Okay? Not done yet. Why? Well, because remember, there is the amortization that we need to worry about, right? At the end of the year, we're only going to be entitled to 1/2 the amortization expense, right? So on 7/1/2024, we're going to record the accrual of amortization, specifically 1/2 a year. So remember, that journal entry is going to be a debit to equity in investee income, and there's going to be a credit to investment Bowdoin. Okay, now we got to figure out the amount. Well, that's easy, right? We know that they're going to have $60,000, right? We know that it lasts 15 years, or that's a useful life 15 years. So we had 4,000 for the whole year. Well, we only get to take 1/2 a year, so it's going to be 2,000. There we go. And again, what is this? To record, half-year amortization. All right. So now we can go back and say, okay, now let's get the actual cost, right? So included in that, we need to include our 2024 entries that we did, okay? So we're going to say we're going to say on 7/1/24, we recorded the basic equity accrual. Which is at 76,000. Oh, sorry. 76,000. And then we're going to record the decrease, the amortization on 7/1/24 of -2 grand. So now when we auto sum this and add all this up, we get $1,172,000. Okay. Now, what we need to figure out is what's the cost, right? What's this carrying cost of these shares that we sold? Okay. So we can do that, and let's just do it this way. Let's look and say, okay, bear with me. There we go. Okay. So this is going to be the total cost that we have. Okay. Now, they tell us that we sold 20,000 shares, but we had 80,000, right? So what percentage did we sell? Well, to figure out the percentage of shares sold, I'm going to divide 20,000 by 80,000, and that gets me not 0 or 25%. So if I multiply 25%, which is the percentage of shares sold, by the total cost, I get, or we get actually, our cost basis, which is $293,000. Okay, so now we can go ahead and we can record the sale of stock, right? Well, think about it. 7/1/24. Hopefully this is kind of like a review, right? We sold stock. Well, what did we get? We got cash. Cool. So I have to debit cash. What else did we get? Or what else happened? Well, there was the investment in Bowden account went down, right? That's an asset. We got to credit it. Now, we can tell right off the bat that we have a gain, right? Just by looking at the numbers, we know that it cost us $293,000. The problem tells us that we stole those outstanding shares, or we sold those shares for $330,000. So we have a gain, right? Gain on sale. Perfect. So what we're going to do is we're going to debit cash. Sorry. I have a dual screen set up here and my mouse doesn't like it. So cash that we get is $300,000. Oh. The investment in Bowden goes down by $293,000. And the difference of $37,000 is the gain on sale. Okay. Now, 9/15, we get a dividend, right? They declare a dividend. Okay, so we can calculate that very, very easily. What we're going to do is we're going to say on 9/15/2024. Oh, sorry about that. Okay, we're good. On 9/15, we end up receiving a dividend, right? So remember, anytime an investee pays a dividend, the investor company has to decrease their investments by that amount. So we're getting cash, so we're going to debit cash. We're going to credit equity, or excuse me, we're going to credit investment in Bowden. Now we need to figure out the amount. Well, they tell us in the problem that, excuse me, they tell us in the problem that the dividends are $100,000, right? Sorry, to record dividends. Or, I'm sorry, we're talking about net income. So it's record, or no, we're talking about dividends. Yeah, record annual dividends, because that's what happens on the 15th of September. Okay. So we know that we own 30%. Well, hold on. The dividend's $100,000. We only own 30% now, so we get $300,000 or $30,000. Okay. So the next thing we need to worry about or concern ourselves with is that net income that they pay, right? Or what's the next thing that happens? Next thing that happens is that we're at the end of the year. So since we're at the end of the year, we can go ahead and record or do the basic accrual, for investee income. We can do the amortization expense, and then I believe that's it. That's really all we have. Okay, so we already recorded the dividend. Now we're at the end of the year. And it's 12/31/24. We are recognizing income or investee income. So I'm going to have to debit investment in Bowden. And then I need to credit equity in investee income. We need to figure out the amount. Well, we know that in 2024, their net income, hold on, bear with me here, to record 1/2 income on remaining 30%. So to do that, all I need to do is take my $380,000, multiply that by 0.3, which is the 30% that I own, times 1/2. And I get $57,000. So I see that my investment in Bowden increased by $57,000, which is the net income. Okay. So now the next thing we can do is we can go ahead and calculate the half-year patent amortization, right? So to do that, which we do very, very easily, on 12/31/24, we're recognizing that amortization expense on the patent. So we're going to we're going to debit equity in investee income, and we're going to credit investment in Bowden. Now we need to figure out the dollar amount, right? Well, think about it. The amortization expense, right? We're only entitled to a half a year, okay? We already had $4,000, right? That's the total amount that we should actually get, right? But we are only entitled to half of it. So bear with me here. Yeah, we're only entitled to half of it, right? But how do we calculate that, right? We need to think about that because we have a change in our amortization, okay? So what we're going to do is we're going to say the annual patent amortization is $4,000. Okay. We're also going to say what is the percent of shares retained. Well, We still have 60,000 out of the original 80,000. We get 75%. Okay. Now, so the annual patent amortization that's current, right, is going to be the 4,000 times the 75%, which is 3,000. That 3,000, that represents the current portion of annual patent. We get half of this, that's 1,500. So we just took half of the 3,000. And that is problem 31. Okay? So thanks for tuning in, and we'll see you in our next video.